sitting on the fence does nothing but hurt your crotch. So you got to jump off and get active. Otherwise, you're not investor. And I would still say, if your fear ever completely goes away, now you're in a dangerous place.
Hello, everyone, and welcome to the Moeller Real Estate and Business Podcast. I'm your host, Phil Moeller, and on this podcast, we will be interviewing guests that have made their mark in real estate, in business, and in other areas of life. Listening to podcasts myself has helped me in so many different ways and continues to do so. If you're a real estate investor or an entrepreneur, or aspiring to be either, or just someone that wants to learn, you've come to the right place. An easy way to have an impact is to share this episode with friends or family, provide a review, or just spread the word. We greatly appreciate it, and now let's get to the show. Hello, everyone, and welcome to this week's episode of the Moeller Real Estate and Business Podcast. Today, I'm very excited for our guest, Andrew Cushman. For those who don't know Andrew, he's an icon in the multifamily real estate space. He chuckles, he's humble, but owner and founder of Vantage Point Acquisitions, chemical engineer by trade, so just really detailed and process-oriented. An alpine ski instructor. I skied with Andrew. We got out the lift together. I think we skied for 3 seconds. I ski slow. He skis fast. So he was nice, and we hung out. But then all of a sudden, like, where'd Andrew go? He's an expert skier. Started with real estate flips, I think, Andrew. But really, you are really within different circles. You are the master within the group of masters, I think. A lot of people look at you that way in multifamily. But how did you get, before we get into some of that, really, business, market, economics, things like that, I think we'll get into a little bit today. But before that, this just didn't happen overnight. There's a story behind this. Tell me a little bit about it.
Yeah, it's like most of the people you meet, it's 20-year overnight success, right? So, as you mentioned, a chemical engineer, I never really wanted to be a chemical engineer. I just, I was an entrepreneur as a kid. I was out raking leaves, shoveling snow, selling golf balls, doing whatever to earn money. And so I knew I wanted to be an entrepreneur, run my own business. I had no idea how to do that. So I figured in high school, I like chemistry, I like problem solving. So I'll go get a chemical engineering degree, and I'll always have a job opportunity. It'll always be well paid, and it's at least something I can tolerate, right, until I figure out what I want to do. Became an engineer. Along the way, met my wife. She had the same mentality, and tried lots of other things that we didn't like, flipping cars, vending, all this other kind of crazy stuff. And then in late 2006, I saw an article in the Wall Street Journal about flipping houses. And we dove into that. And in 2007, flipped our first condo here in Southern California. Made as much flipping that condo as I made all year at my engineering job. And I said, I don't know how I would get a clearer sign than that. I am out of here. Went full-time into flipping. 2 years later, Veronica joined me full-time. And then what we did, we had good years. 2008, 9, 10 were great. But anyone who's flipped knows that that is a full-time job in and of itself, and it is a grind. You're only as good as your last deal. Hopefully you made a profit. You put it in the bank. That's nice, but you got nothing residual, nothing to show for it. And so we said, well, hey, what's something that provides, recurring income and more long-term wealth? I said, well, okay, probably apartments and rentals. And then we also said, hey, we just had a huge recession, which means we're probably about to have a long expansion on top, which means, household formation and job creation. On top of that, everyone and their mother just got foreclosed on and can't buy a house for the next 7 years. And the people who didn't get foreclosed on, know people who got foreclosed on, and they're scared to buy a house for the next 7 years. So we're going to have an expanding economy in a massive rental pool. We better figure out how to get into apartments. And so we did. We hired a coach, and in 2011, our first acquisition was 92 units out in Macon, Georgia, and went full-time into apartment syndication, and 2,800 units later, here we are. So,
first of all, I didn't say that in the intro, but 2,800 units. I want to ask you a question about, you said you're flipping. First of all, a comment on flipping. All businesses have, I think, a different spectrum of full-time, active to passive, right? So like someone that wants to invest in a deal of yours, on one hand, can be very passive if they know you and trust you, which you're a great operator. But they should do their homework up front. Like it still should, your activity should be
Yes.
studying the operator, not just trust the person and go. But you say flipping is very active. I was talking to a business owner a month or so ago, and we were talking about different businesses. He said, "Yeah, I think I'm just going to switch to flipping though because it's so much easier and so much less stressful than what they're doing." Now, what the other thing they're doing isn't real estate. So there's just this whole spectrum of real estate we think about, and flipping is like the most active to, passive investors, most passive. But I think the spectrum of real estate and how passive it is relative to a lot of businesses, even flipping can be relatively passive. It's really about how you set up your team. But anyway, I thought of that just a comment on that, and you can add to that. But my question for you really is, because we're going to talk about this, did you really have the insights? Like we're clearly coming out of recession, and there's going to be like you knew in 2009, 2010, like okay, we're going to have a long upward trajectory market, so it's a great time. Did you know that?
Yeah, that actually was an intentional decision. I had actually got interested in and started, and I bought my first stock in, oh geez, I think it was seventh grade. I mowed enough lawns to save up enough to buy $1,000. Instead of buying video games, I bought $1,000 worth of stock, and ended up actually, I think, losing most of the money on it. But what I learned was from a very early age, I enjoyed studying the markets and financial stuff and economics. And even though stock trading doesn't have anything to do with real estate, the economic principles and some of the things that you learn actually do translate. And so, yeah, that was an intentional, conscious decision. We said, you know what, flipping, the good days aren't going to be as good, and it looks like apartments are going to have a big run, and so that's why we switched the business.
Man, if you started like yeah, so your timing of starting that, and it was a good long run. And I would say that run took its first hit probably in the last couple of years. Honestly, it was I don't know if there was a dip, but if it was minor. Just as of late, of course. Um, but I want to talk. So I want to talk about you've been studying. By the way, that $1,000 is probably the best money. Whatever you lost is probably like talk about starting early and losing small, and then like setting yourself up for later. Like, how much better is it to lose that thousand? Like, yes, I've lost money. It's called my own in the stock market when I was in seventh grade. So you talked a little bit about the market. I kind of want to jump there, then we'll hit some other topics. But like before we get into real estate in the market, where are we kind of from a market perspective as a whole, like a broader macro economy?
So it would appear that we might just be achieving the mythical soft landing. Obviously, we could spend days arguing back and forth why that's either, why we're either going to take off or have a big recession. And, at the end of the day, none of us really know. And when it comes to investing, you have to have a base case and then hedge against the outliers. So in terms of multifamily, where the market is, I can't really speak to office or industrial or anything like that. Multifamily pricing is down, I would say 20 to 30% from the peak in the first quarter of 2022. It seems like multifamily pricing hit bottom in about February of this year, and we have been bumping along bottom ever since. When do prices start turning back up? Don't really know. It kind of depends on interest rates and supply. My guess is it could actually tick up a little maybe next year, and then by the time we get to 2028 and 2029, I expect pricing to be significantly higher than where it is today for a handful of reasons. And so I would say the base case is multifamily has bottomed out in terms of pricing. The two exceptions to that would be if longer dated treasury yields, meaning the 5-year, 10-year on,
Yep.
significantly rise from here. Like as we're talking, they're hovering just a little below 4%, right? If all of a sudden they're 5.5, then that's going to require another market adjustment.
Yep.
I don't think that's going to happen in the near term, but if it did, it would cause an adjustment. If we do have a major recession and unemployment spikes to 6 or 7%, then interest rates would probably come down, but property operations and net operating income would deteriorate, and therefore the properties would become less. I think the odds of both of those and both ends of the spectrum are less than the odds of we just kind of bump along and eventually move upward. So.
Yeah. I think you're right. So you talked a little, like you referenced like your like base case. So I want to talk about like a general person's investment thesis. Like my investment thesis right now is I'm not speculating that we're going to go in either of those two directions, right? I'm like my speculation is I'm not speculating. I'm saying, does the deal work now in the current interest rate environment? And do I have plenty of like, is my debt structure put on top of that where I have flexibility with what I do? So I'm doing some things like, I would Fannie Freddie debt, for example, right now is lower than bank debt, but I can get really good terms and prepayment penalties, rate modification terms on bank debt, where if rates do drop, I can really take advantage of those. But if they don't drop, I can be locked in. But I've heard in the last, I guess, 6 to 12 months, some people are thinking, well, the rates are higher, they're going to go down. So, people got themselves in a lot of trouble 2 years ago with bridge debt and other things. And now here we are again. And that doesn't sound near as bad to me now as it did then. But you just talked about the potential for like the 10-year, which is 3.75 or so today, to go up to 5 or so. Like how careful do we have to be that they might go up, I guess? And even the broader question then is like, what's your investment thesis in general after you talk about the rates a little bit more?
So our base case, I mean, in any of us, like predicting interest rates even like 2 weeks out is kind of a fool's game. Never mind 2, 5, 10 years. And if you look at the forward rate curves, which are always wrong, by the way, but they do give you a good sense of market sentiment. In terms of market sentiment, I fully agree with the forward-looking rate curves. And if you want an example, anyone listening wants an example, just Google forward rate curve 10-year Treasury, and there's a company called Chatham, Chatham, that puts them out, and it's very simple, and it'll make sense what we're talking about. I think one mistake a lot of market participants are making right now is like, oh, cool, the Fed's starting to cut rates, interest rates are coming down. Yes, but what rates are you talking about?
Mm-hmm.
So yet the Fed is cutting overnight rates, right? Literally the overnight lending rate between banks. So that'll bring that down. Short-term money like 1-week treasuries, 2-year treasuries, that'll come down. Longer dated stuff, which is what most multifamily and commercial loans are based on, 5-year treasury, 7-year, 10-year, those probably have already bottomed. And especially if we do achieve a soft landing and continue with an expanding economy, the trend is actually they'll probably move steadily upward, especially where we have a 7% of GDP national debt that we can't fund, where that's going to require massive amounts of treasury issuance. The more that gets issued, the more supply that meets the demand, and therefore pricing of the bonds has to be lower to get people to buy it. What does that do? That sends yields up because those two work inversely. And so there's a lot of fundamental factors that indicate upward trends on treasury rates. Also, the yields on the 5 and 10-year U.S. Treasury tend to front run the Federal Reserve by about 12 months, meaning same thing with the stock market, right? Both of those markets, they anticipate the future and price on that. The stock market's not priced for today. Bonds aren't priced for today. They're priced for 6 to 12 months out. And so with the yields that we're seeing today on the 5 and 10-year are already factoring in the fact that the Federal Reserve is going to end up cutting like 200 basis points total or whatever that number is. And so that's why when the Federal Reserve cut 50 basis points last week, if you noticed, what happened after that? Ever since then, the yield on the 5 and 10-year has gone up. It didn't go down, right? So we actually locked our refinance a couple of days before the rate cut because we figured, it's been fully baked in. Once the rate cut happens, there's nothing less to anticipate. And now yields have gone back up.
Yep.
So there'll be fluctuation. We might hit 3.5, we might hit 4. But I would not be holding out for materially lower interest rates. And whatever would need to happen to get them there is probably not something any of us wants. So,
so given that, then what's your investment? You're looking at deals, right? You're looking at a lot of deals. You're putting offers in, but offers that work, I think. But like, what's your investment thesis? Like, what what are the criteria that says yes, this deal makes sense to you?
Well, and you touched on it. It has to work today. So we're largely we're fixing, and we tend to hold 5 to 10 years. And one of the beautiful things about commercial real estate, is, or at least with apartments, is time is generally on your side. Time is typically your friend, unless you've got a loan maturity with a floating rate. So we're looking for deals that we can feel like we're getting a really good basis. Replacement cost is still incredibly high. It's really expensive to buy something, to build something.
Yep.
Good basis is getting easier to find with prices down 20 to 30%. We want it to cash flow to some degree from day one, and we want a very clear executable path to upside that is largely within our control. And say, well, what does that mean? It's not anything fancy, but we go into like we'll go into a market. If we identify a deal, we're going to buy that deal if number one, we have a good basis. Two, we can put the right debt structure on it. Three, if in today's market the rents are significantly below its peers. That could be 200, 300, and it could be for whatever reason, poor management. Ownership hasn't been able to put the money into it. There's lots of reasons. Just sometimes people just like, hey, I just want to sit here and cash flow. I don't want to mess with this thing. And if I keep rents really low, it's easy. There's lots of reasons for that. So we want a clear path to upside in wherever you take a snapshot of today's market. And then if the market improves and we get rent growth down the line, that's just gravy on top. That's right. But that does not have to happen in order for the deal to work. You want our investment thesis is the deal works under today's circumstances, and anything that we're underwriting to in terms of assumptions, meaning rent increases, expenses, all the factors that go into that, there's an 80% likelihood that those things will happen and or that we can execute on them.
Yeah. And the other thing I think I'll speculate about you from knowing you and how you operate is you're in control from the operations based on the markets you're investing in as they are today. That doesn't mean you're not studying those markets very, very thoroughly. You're studying those markets so that you can operate and you can control your own destiny, and you can hit your 13 or 15 or 17% IRR returns, whatever those are. But you also have choices to make the same investment, let's say, in 5 different markets, and one's declining in population or doesn't have household income, and the other one does. You're very strategic about picking those markets. And yes, this has the operations we can control, A, and B, the likelihood of getting the gravy on top, if you will, from the market is higher because of the markets we're selecting.
Exactly. And so it's like this. If you're in a canoe, you have full control over how hard you paddle, the direction you turn, all of those things.
Yeah.
But if you're in a river and you're paddling upstream against current, it's going to be a lot harder to cover a mile with a given amount of time and effort. If you're trying to cover that same mile going downstream with the current, it's going to be much faster, much easier. And it's the same. And that's what market selection does for you. Yep. If you have a strong current moving in your direction, it dramatically increases the odds that you're going to achieve what you want to achieve and lowers the risk.
Yep. Well, I want to kind of go. So first of all, I appreciate just the insights on your investment thesis. Kind of, one thing I've learned for sure is like I went through this process of doing some active deals, passive deals, back to active, and just the idea of having control over the markets I'm in, the properties, the operations. For me, like I'm absolutely looking for that, especially when I have investor capital involved, is just being in control of the outcome. I mean, okay, not 100% control of everything, but really, to the best of my knowledge, yes, right, as much as possible. So I appreciate that, and I know you're sincere about that. But I want to go back. So you talked about you shifted to 2010, 2011 timeframe to multifamily, and then all of a sudden you said 2,800 units later. What were some kind of major just shifts even throughout that process that you made that kind of either you learned from, accelerated your growth, changed your mindset during the last decade and a half?
So I'll give you 3 positives and then one big negative that we turned into a positive. So probably the three biggest like accelerants or turning points are all team and people related. So number one, my original mentor, he helped guide us through the first deal. It was excruciatingly difficult to get the money raised, to get it closed, to do all the work. And afterwards, I was like, okay, I do like this business. This is great, but I don't want to do it on my own. And so we approached him and said, hey, can we partner with you? And he's like, actually, yeah, we like working with you guys, with you. We'll do that. So we partnered with him and his partner, which were both named Mike, right? We just call them the Mikes. And we ended up doing 5 or 6 deals together. We're still partners on some stuff today. It's been a great relationship that accelerated our business. A few years after that, David Osborne, Pat Hyben, and Tim Rode, they approached me. They had been investing passively in some of my deals, and they said, "Look, we love investing passively with you, but you know, we know a lot of people with investable funds, and how about the 4 of us form a partnership? We help with that, and you go do your thing, finding and operating deals." I'm like, that sounds great. And that was in 2013. So 11 years later, the majority of those units have been, done with David, Pat, and Tim. We've got a thriving, partnership now. I love working with those guys. And, never mind the depth of knowledge and experience that you put the 3 of them together. It's just
Right.
insane having the ability to work with and talk with them. So those were, and then, the third one is about 5 years ago. I brought on Anthony and Kelly, who are now our head of asset management and head of acquisitions. And I mean, you hear people talk about it, and it's like, okay, yeah. But until you experience it, you just don't understand. It's hard to understand when someone says hire people that are better than you at their specific roles. That applies to them, and they do what they do on our team better than I ever had the ability to do by myself. And so that was a huge accelerant, and has really improved our operations and just everything we do. A big negative is in 2013, we bought a 350 unit early 1970s neglected property in a very rough part of South Dallas, Texas. And the short version is we had stuff, we had domestic violence, we had someone crawled up on top of the leasing office, knocked out the skylights, threw Molotov cocktails in there and tried to burn the whole thing down. Shootings, I mean, everything. And then on top of that, we would renovate units, get a nice rent increase. People would move in. 6 months later, they'd stop paying rent. We'd have to evict them, and then they'd destroy the unit on the way out. So we couldn't even just like paint and carpet. We had to renovate it again. And so the property was that's what made me gray. Very difficult to run, very much more expensive than we anticipated. And then in 2015, I don't know if you remember, everyone thought a recession was coming in 2016. Like Kiyosaki even put out a book about the 2016 crash and all that stuff. And so we said, look, these hard C-class properties, they don't do well in recessions. They get hit the hardest and the deepest and the fastest. And so we don't want to risk holding this in a recession. And number one, Warren Buffett's number one rule is never lose money. And so we said, you know what? Let's just let your winners ride and cut your losers short. So we sold it early in late 2015 and returned all capital and a 5% 2-year IRR and a 1.1 equity multiple. Worst syndication we've ever done by far. However, what we learned from that is we very much did a postmortem, and what we learned from that or came out of that is our screening process now, where we only buy in properties with very strong population growth. We only buy properties in areas with very strong median incomes that aren't in flood zones, that have very low crime, that are either landlord neutral or landlord friendly, in addition to a bunch of other stuff that today a property like that would never even get through our initial filter. We don't buy 1960s. We don't buy 1970s, with maybe a rare exception if something came up. So while that was the worst deal financially we ever did, it actually probably set us up for a lot of the success that we had afterwards, because we learned all the things that we did not want to do, and that made all deals after that far better. Not that they never had another problem since then, but nothing anywhere near to the significance of that.
Yep. What about, I didn't know, so I thought you may be going there, or another lesson, which was um, the thought process during the hold period. So earlier you said, look, generally speaking, over time, real estate, if you just the more time you have on your side, the better. However, you were looking, I think, at risk reward. Your risk of selling was all investor capital back, small IRR. We didn't hit our target, but they made some money and probably decent relative to the stock. Just like not a total loss. They got something, but the reward of holding could have been, okay, you could have hit your projections of 13, 15, 17% IRR, but the risk of holding could be, man, we might lose investor capital significantly if there truly is a market downturn. So I guess what lessons from that, like would you do that differently in hindsight, or kind of the same thought process?
It turns out we were wrong, but I still would not do it differently in hindsight. So the recession in 2016 never happened. Multifamily pricing continued upward. And when we decided to sell, we still thought like, yeah, we can turn this around. We can we can get this to where we anticipated. However, the risk reward ratio had changed.
Yep.
And, you got to be careful of survivorship bias, right? Like just because you made a decision that turned out doesn't mean it was a good decision. Like if you go to a bar and get drunk and drive home and you make it safely home, it doesn't mean that was a good decision to get in the car and drive home.
Right.
And so that's how I look at this. Like given what we knew at the time, protecting capital as job number one, that meant the decision of, hey, look, we can get out and still protect capital and return a small profit. If we know we can, that's 100% certainty versus maybe a 50-50 chance of saying, hey, this was a great deal and let's all celebrate. The risk reward ratio wasn't worth it. So even looking back, yes, it would have worked out just fine. We still made the right decision given what we knew at the time, based on rule number one: never lose money.
Yep. And what I love I say, like, I like the word risk reward ratio. I say a lot of times, I actually say this in the concept of taking action, which is like if people are thinking about should they buy their first deal, or that single family duplex quad, or like taking the different steps, just assess what's the best thing that can happen. What's the worst thing that can happen? And a lot of times I'm encouraging them to take the action, saying the best thing is probably not, you probably don't have visibility to it because you can't connect the dots forward. So like the best thing a lot of times is what you learn from the experiences and maybe even the pain. But in this case, you were very clear. Like, again, I like the phrase risk reward ratio. Like the best thing that could have happened is, okay, your investors could have got that 15%, but the worst thing is dramatically worse. So I credit for you for that. And again, just from getting to know, I know you take Buffett's rule number one very, very seriously. And what I like about, if I go back to your positives, I talk about this, but the power of association and who your network is, mentors. You mentioned a business coach when I think even when you were buying your first 90 unit or whatever it was, multifamily, dude, like the power of your association, your network, like you will become with whom you associate. And I think that just since you said three things, all dealing with people is so, so powerful. So I like that a lot.
Yeah, you're absolutely right. And we've had coaches the whole time, for single family flipping, for multifamily. Now I have just a general business coach. It's much better to learn from other mistakes than to make them yourself and learn. So.
Yeah. And again, and just to not gloss over it, but the thought process of hiring, do you think you hired soon enough in hindsight? Like, again, nope. I know hindsight's 2020, but you would have taken that risk, your own personal risk of hiring a little sooner. You would have done that, or how do you think about that?
That was one of my biggest mistakes that was fully within my control, is not hiring earlier. So I would, that's one thing is I would tell people, and we do this now, is hire before you think you need to. And people always say, well, I don't know who to hire, what to hire, whatever. If you're looking at your first hire, basically executive/admin assistant is almost always the first hire, and it is life-changing.
Yeah. Yep. And for me, it has been too. So Vanessa, who will help edit this and do the work for me. So thank you, Vanessa. There you go. How about that? On-air credit. She will not like that, by the way. So I'll add to it, Vanessa, you are not allowed to edit this section out of the podcast. But it is really the way to think about it is like the value, it's not the value of the person you're hiring and the dollars, it's your time. And what are the most strategic, most influential, impactful things you can be doing? Like for you, my guess is that's just, connecting with large investors or connecting with very strategic brokers or owners, right? Like that's the highest return on your time. In addition, so it's like it's deal flow. We've heard this, right? It's deal flow, it's team engagement and culture, and it's creating the vision for your business. Those three things are what I think founders should be focused on. And if you're doing a lot of tactical work, then you're really costing yourself money. So I credit for you pulling the trigger, and I think I'm in the same boat. Like now that we have a team and they're better at what they do than what I could be, it's like it's opened up my eyes.
Well, and being an entrepreneur slash investor is also going to be a bit of a lonely business.
Mm-hmm.
And I have way more fun now with the team we've built than when I was doing it basically solo. I did it solo for way too long.
Yep. I love it. I love it. Well, I want to, you talked about just I guess one thing we didn't talk about is when in your investing journey, like what moves that you made were like when did you have the most fear and how did you get over those items?
Oh, there's a couple of points. One, of course, is doing that first deal. People always ask me, well, how did you get that deal? How'd they award it to you? Well, number one, I had a coach, I had some education, and I was very naive. So I was about as confident as a 4-year-old in a Batman t-shirt. And then on the other side of that, the broker saw a sucker coming from a mile away. Right. So, I mean, I had the fear, but it was, well, it's like, okay, at some point you got to do something. If sitting on the fence does nothing but hurt your crotch. So you got to jump off and get active. Otherwise, you're not an investor. And I would still say, if your fear ever completely goes away, now you're in a dangerous place. I even after, I don't know, I get 15 years and thousands of units, every time we go under contract or something, at least once or twice, I'll wake up in the middle of the night and be like, did we get those rent comps right? Or, oh, what about this? Right. I mean, and it's not fear. And then I just, I look at our due diligence and like, oh, okay, yeah, we're good. We covered that. But, I would say, don't try to make fear can be your friend as long as you work with it and just and when it comes, fear there's a lot of things it boils down to, but one of it is just a lack of knowledge. Like, did I get this investment right? Well, what's your concern? Well, I don't know if I'm going to get the rent bumps. Okay, well, dive into what the comparables are. So yeah, that was fear. And then we made, when we made a pretty big jump, we had at the time, our biggest acquisition was 8.55 million. And then the one after that was 49.8.
Oh, wow. That's a jump.
And so, yeah, I definitely had some fear about making that big of a jump. But, we had the right team and we actually did it really easily. It was a smooth ride. But I was concerned. I'm like, can we raise $18 million in capital? Right. I have no idea, but how we got over that, as I looked, I said, look, I know this is a really good deal. So the worst case scenario is we can go find somebody to come in and help. Right. Yeah. So again, you never want to have no fear. You want to use that to figure out where the weak spots might be and then just, take it head on and address it.
Yeah, I love that clip. And we even talked about some different fears or some different just the risk reward ratio, which are ways to think about fears and stuff like that too. So I really like that. So September 2024, where are you at? Like, what's next? And really, like, why you're in a pretty good spot financially. So why are you doing it? Like, what's really driving like what you do and why, and how has that changed over time?
In the beginning, it was really just about getting into a business that I would enjoy would provide horizontal income and, time freedom and wealth building and all of that. And notice I did not call it passive income because there's nothing passive about it when you're doing a syndication business.
Right.
But that was the original driver. Now that's still part of it. But what also drives it is number one, I've built a team that I really enjoy working with, and I see it as my responsibility to try to provide as much opportunity for them as possible and not be like, oh, you know what, I'm done, and no, sorry, you guys figure it out, right? And so continuing to provide opportunity for them, and then also just being a good steward. When you look around at just all the people who would give their right arm to be in a position that we're in of running your own business, having good income and that level of success, I'd be a bad steward to just be like, yeah, I'm done, right? Where, you know, I can continue to build this and grow this and positively impact more people, and positively, and same thing with my own family. So, having a team that I enjoy working with, enjoying the business, there's just something, I don't know, satisfying about walking a property that's beautiful and safe and well run and financially successful and be like, oh yeah, we control this, we did this. It's the tangible aspect of it is great. And then also I've had residents come up and high five me, and be like, "Hey, you're the owner." I was like, I work for the owners because the owners are the investors." And there's one lady, she's like, "Oh, give me a high. Oh, thanks for improving this place. You made it so much better. Do you like barbecue? Next time my husband and I'll make you barbecue, right?" So like that kind of thing is very satisfying. So and I see a big opportunity in the next 5 years. So.
Love it. And I think there's this, I've been thinking about like this, there's this financial maturation process where you go through like the different reasons you're doing it and money, like now it's less about money for you, but money or returns for your team, for your investors, the impact you're having on your residents. And what you do, I know specifically, is just by being vocal about like what good investments look like, just giving guidance, knowledge around multifamily, around the market. You also impact a lot of other investors that you've never met before through the different platforms and forums that you are just out there and helping people with. So I appreciate it. You've had an impact on me, and helped me become a better investor too. So through that, then, okay, what's just the ripple effect that you have had? I think is really, really cool and probably hard to grasp. So with that, how does what you do, how does it make you feel?
I mean, I enjoy it. It feels good. I actually, it's funny, you're talking about the ripple effect, and sometimes you don't even know. I have two handwritten letters that people showed up one day, and both of them now are a couple of years old. And it was just like, hey, I don't know if you remember, but we had this conversation, and it totally changed my direction and all this, and now I'm doing this and that, and I just wanted to reach out, and I'm like, I don't even remember that conversation.
Yeah.
And so yeah, that's definitely a big positive. I actually keep an email folder that it's titled positive. And whenever I get emails about, oh, we really appreciate this or thank you for this, I save it in there. And if I'm ever feeling, down or whatever, I can go in and read all of that stuff. And thankfully, actually, I very rarely need to. Sometimes I'll go in there just for fun. But yeah, I actually save all that stuff, and as as a motivation, and kind of like, well, hey, part of why do we do this, and it's yeah, it's a really satisfying part of the business.
That's just really cool. And I think just again, the compounding impact of what you've done has been really neat. And I think two things, you said something about 10 or 15 minutes ago about like being an entrepreneur or a solopreneur, if you will, can be really lonely sometimes. Like to the business owners out there, just know that like I think business owners, I think people in real estate investors, you're in a position to have a great impact. And it's sometimes hard to recognize it because you're not, when you're having a tough discussion with a resident or an employee or an investor or whomever, those tough discussions aren't reminding you of like the influence and impact you have in a positive way. So I also like the positive folder thing, but just for entrepreneurs and business owners in general, there's just a lot of influence and authority you get because of the position you're in, whether you like it or not. But I think taking advantage of that and doing good things with it is cool. And I think for yourself, if you need it, I like the positive folder comment or just the concept of that. What do you think is going to be the key to your success moving forward?
Adding, as we grow, adding the right people to the team and continuing to maintain our discipline in investment criteria and underwriting. And so in a sense, nothing different. I mean, that's, a lot of investments, especially multifamily, are going bad these days. They're, upside down. The loan's worth more than the property. They don't have cash flow. All these things are happening. Thankfully, we don't have any of those issues because of, every property we have. Not every property in our portfolio is, way above pro forma right now, but every property is cash flowing and every property is making distributions.
Yep.
And we don't have any big loan maturities coming up. We didn't do the whole floating rate thing. We just said, we just looked at it statistically. I mean, I didn't predict the Fed was going to jack rates 500 points. We just said, hey, like in 2021, for example, when we were buying that big deal, we said, well, wait, interest rates are at the lowest in history. Statistically speaking, the odds are greater that they'll be higher in the future than lower. So let's just fix this thing. So we have a 12-year loan at 3.79%. that, needless to say, makes that property a great asset right now.
That loan is worth a lot of money in and of itself, right?
So, just applying the same principles of buying a deal that works today and setting it up so the odds are greater that'll be worth a lot more in the future. And screening for the right market, screening for the right properties. We're under contract on something right now. First time in like 18 months. We've looked at 800 properties, and this is the first one that we've gotten under contract. I hope that number will go down in the near future, more like 100 to 1. But no deal is better than a bad deal. So just bringing the right people on the team, maintaining discipline when it comes to investment criteria, and just keeping those big picture things in focus.
Love it, love it. A couple of closing questions here, Andrew. Thanks so much for your time. Most impactful book that you have read?
That's actually so I'm not a big reader. I'm lucky if I read one a year. I listen to literally 1,000 podcasts a year, but probably the most impactful one I'm going to say early on is Jim Camp's Start with No. It's become a little more part of the culture now, but it was at the time he wrote that book, it was very much counter to the whole, win-win, get to yes, all this kind of thing. And the idea is like the most comfortable word in a negotiation is no. Right? Think about when you go to a car dealership and the car salesman is just pushing you to buy a car and to sign and to get, it makes you feel uncomfortable. It makes you back off. It makes you question what's going on. No is safe. If you're not trying to close somebody aggressively, they feel more comfortable. That book, candidly, is a huge part of why we were able to be successful in the flipping business. So I would say that. And then the two I would add to it are ones that probably most listeners are more familiar with. How to Win Friends and Influence People, and then Chris Voss's Never Split the Difference. And in actually Never Split the Difference, he quotes Jim Camp a whole bunch.
Oh, really?
Yeah.
Yeah, I've read Never Split the Difference. I have not read Start with No, so I'll add that to the list. Andrew, thanks so much. I mean, so much wisdom here. The big mistakes and then the positive, just around people and associations and team, getting coaches, your insights on the market, where we stand, just entrepreneurship, solopreneurship, the impact and the ripple effect you're having, the positive folder, all great stuff. And again, for our listeners, if you don't know Andrew, you need to follow him. You need to check him out. He is He is a wizard in the space. Andrew, where can people find out more about you?
So I'm not a dancer or selfie guy, so I'm not on Instagram, Facebook, or TikTok. However, I am on LinkedIn. That is the one social media platform that I'm on, and that is me posting and commenting. So if you actually want to interact, LinkedIn is the way to do that. And then also our website. If you just Google Vantage Point Acquisitions, I don't know how, but we have really good SEO. So that'll come up. The website's vpacq.com, and there's some tabs on there to, connect with us in different ways. So.
Yeah, and make your own decisions, be thorough, but I'll just say, the fact that Andrew talked about, they've been looking for deals, and I know, this is what they do. They look for deals. They've been looking for deals. They've been putting in offers for 18 months, and there's an opportunity. So definitely check it out. Andrew, I appreciate it so much. I know you're busy, so thanks for coming on. And again, to the listeners, check out Andrew for the Moeller Real Estate and Business Podcast. Signing off.
All right. Thanks, Phil.
Thank you for listening to the Moeller Real Estate and Business Podcast. We hope you found today's episode helpful. If you know current or aspiring investors or entrepreneurs or anyone that would benefit from today's episode, we appreciate you sharing it with them, or better yet, providing us a 5-star review. To learn more about Moeller Real Estate, visit our website at www.moellerre.com. You can also sign up for our newsletter or local events via our website. In closing, I encourage you to be purposeful in all areas of life, educate yourself, network with others that have been successful, take action, and lead. Thank you.